Welcome to Invest Well, Be Well, a podcast for wiser investing and stronger living. I'm Rusty Vanneman, longtime investment professional, and I'm joined each week by my co-host, Robin Murray.
Thanks, Rusty. I'm a storyteller and journalist, and I am so excited to explore the ideas, insights, and people shaping the intersection of performance and purpose.
This podcast is for thoughtful investors and driven professionals who want to grow in their portfolios and in their personal lives.
We'll talk long-term investing, behavioral finance, personal development, and what it takes to live and work with intention.
So let's get started. Let's invest well and be well together.
This podcast is brought to you by Main Management LLC. Since 2002, Main has been recognized as an ETF strategist that combines an institutional process with the personalized service of a boutique firm.
Invest Well, Be Well is also sponsored by State Street Investment Management. Founded as a pioneer in ETFs, State Street Investment Management, through its SPDR brand, brought the first U.S. ETF to market with a SPDR S&P 500 ETF Trust, commonly known by its ticker symbol, SPY.
Our guest today is Don Calcagni. He's the Chief Investment Officer at Mercer Advisors, and that was a jam-packed interview, lots of insights and information.
Yeah. So as you mentioned, Don is the Chief Investment Officer at Mercer Advisors, and he is one of the most thoughtful voices in evidence-based investing, and it comes through in this interview. Don brings a rare balance of academic rigor, but also real-world practicality. He is someone who can cite peer-reviewed research, but he can also translate it into clear, actionable strategies for everyday investors. His philosophy centers on timeless principles, such as diversification, cost control, and discipline, and he's passionate about helping investors stay focused through market noise and change. I had some takeaways. What were some of yours?
Well, first, I just thought it was interesting to hear from him about how a giant like Mercer operates, right? And the investment philosophy that they have, their beliefs, and what they do is just super interesting to hear about that. He also talked a lot about, we asked him about these secular shifts that are happening with things like AI and energy. And he said, put those things into context. AI is not actually as new as we think it is. And certainly technological innovation is not new. We've been through some of these things before. So I thought that was just a good way to look at it.
Yeah. Two of my quick takeaways is, well, first of all, I've spent nearly 20 years as a chief investment officer. And a lot of these questions, quite frankly, I have received. And I actually was getting a little bit jealous listening to Don. He was answering them so well. And I was like, dang, that's really good. I have to write that one down. So again, in terms of comments on wise investing, this is really top notch. The only other thing is that he does live basically right off the Penn State campus. Mm-hmm. And you and I, of course, are Nebraska fans. And this podcast is being published 2 days before the big game between Penn State and Nebraska. And none of us wanted to make a bet on the game. So that's how much confidence we have in our teams right now.
We'll see what happens.
That's right.
All right, let's take a listen. Well, Don, welcome to the show. Welcome to Invest Well, Be Well.
Robin, it's great to be here. Thank you.
Glad to have you.
Well, Don, a tradition on our podcast is to begin with a walk-up song to set the tone for this interview. What is your walk-up song?
My walk-up song, Rusty, that would have to be The Eye of the Tiger from Rocky, from the Rocky movies. I grew up outside of Philadelphia. I'm of Italian descent, and I come from a blue-collar town, so I feel like that song really captures my life journey.
That is such an awesome pump-up song. Have you actually used that before a presentation? I bet you have.
I have, a lot of times I'll listen to a couple of, just some songs before I go on stage and do a big meeting. So that's certainly one of them. There's probably several others in there, but that's certainly one of my go-tos.
The reason I ask is that's such a great pump-up song. I think if I heard it and went out for my presentation, I would be too jazzed up.
Yeah, right. You don't want to hit anybody.
Oh, I know. Exactly.
Well, great addition to the playlist. All right, well, Don, we want to ask about you and your background. You started out as a financial advisor at Mercer, where you've been for the last 10 years. Tell us more about Mercer. What's the culture and what's the investment philosophy like there?
Yeah, I mean, Mercer is such an interesting organization. I've been here now, Robin, 21 years. And it's been amazing just watching the firm grow over the years from what was originally, when I joined, about 28 people on the planning side of the organization, really watching it grow up from a small mom and pop RIA to what it is today, which is close to 1,400 employees and nearly $100 billion in assets under management. And so it's been an interesting journey. It's been an amazing ride. But the one thing I love about Mercer is that despite our growth over the past 20 plus years, is it is still very much a very flat structured, family focused, team member focused culture. We have our roots originally, we were founded by Rick Mercer. He was an estate planning attorney. And so if you think about that, our cultural roots as an organization really go back to really the law firm that Rick had founded back in the late 1970s. In 1985, Rick incorporated the law firm into a registered investment advisor. And so having that fiduciary ethos, that focus on comprehensive balance sheet planning, looking at clients' entire well-being through a very holistic lens has really been a huge part of our planning philosophy. And I think that has really informed what the culture continues to be at Mercer. Still very people-centered organization. Yes, we are an investment management firm, but frankly, that is just one dimension of what we do. Today, we also do tax return preparation. We do give tax advice to clients. We have an in-house estate planning team that is working with attorneys and drafting wills and trust agreements and things like that. So it's a very comprehensive organization, but through it all remains really focused on the client and really focused on creating an awesome atmosphere for all of our employees. One thing I'll also add is that it's somewhat unique among large RIAs is that approximately 50% of our employees are actually shareholders in the company. So that's somewhat unique, I would argue, in the RIA space. And so I think that ownership mindset combined with that comprehensive planning ethos really drives us as an organization. Robin, the second part of your question had to do with our investment philosophy, and I can talk for hours. I'm sure, Rusty, you and I can go on for hours talking about markets and investment philosophy. But what I would say is it's really simple. We really try to focus on helping clients have a plan, right? We believe that planning is a prerequisite to successful investing, and not just having a plan, but having a plan A, a plan B, and a plan C, because life is going to throw us curveballs. From an investment perspective, we also believe in diversifying broadly, very broadly, across and within major global asset classes. We do believe in taking a very systematic approach to diversification. We are factor investors. We don't believe in chasing celebrity managers or picking individual stocks. We do not support market timing and things like that. And naturally, we focus on keeping fees and taxes and things like that as low as possible. So we firmly believe in keeping it fairly simple for our clients.
Before I follow up on the philosophy, I just want to comment, having done due diligence on hundreds, if not thousands of firms, one of the things you always want to identify are those firms that not only eat their own cooking, but also have that broad equity ownership. And Mercer has that. So I'm just saying from a due diligence standpoint, you do want to work with firms exactly that has that broad ownership. So kudos to you.
Thank you.
Well, on the investment philosophy, you are known for your appreciation of peer-reviewed research. So how do you balance the insights of academic research with the practical realities of working with clients in real-world markets?
It's a great question, Rusty, and I think I get that question fairly often from asset managers, but occasionally clients. And the first thing I would say is that really the best academic research actually begins with real-world data, right? I mean, Rusty, I know you and I are familiar with like the Fama French paper from 1993 and the three-factor model and all the other papers that followed after that. If you really think about a lot of that research, that Nobel Prize-winning research that's really propelled the profession forward over the past 3 or 4 decades, all of it is really predicated on real-world actual returns, right? Think of the CRISP database at the University of Chicago. So I like to highlight that, Rusty, because a lot of times when folks hear academic research, they think, oh, this is stuff that's being cooked up in an ivory tower. It's not real world. No, if you actually understand the academic research that has come out of places like the University of Chicago and MIT and other places, it is based on very, very real world data, right? It's not theoretical. So I think that'd be my first point. I think the second point with respect to clients is making sure that we appropriately set client expectations around what they can expect from their portfolios. We live in an age where there is so much what I call financial pornography out there on the internet and everywhere else that really does a poor job managing investor expectations. So I think a big part of our job as advisors, Rusty, is to manage investor expectations, to use technology to personalize their portfolios where we can and where is appropriate. I think that's really the hallmark of what it means to be a wealth manager, is marrying the personal with the portfolio.
So as you talked about, some of the best academic work doesn't always translate for individual investors. For example, David Swenson's model, which favors alternatives and active management, and made Yale's endowment one of the most successful in the world, that may work on the institutional level, but not the individual level. So how do you take great theory and make it work for the everyday investor?
Well, I think the first thing to highlight is the way that we manage Mercer advisors. We manage our investment platform just like the largest institutions in the world, right? We manage nearly $100 billion for our clients. Our investment decision-making here is centralized under the auspices of an investment committee. When we are allocating to whether it be a private equity fund or a public markets manager, we are actually negotiating that access. We are negotiating the economics of that particular investment at an institutional level. So while individual advisors and individual clients naturally will have an allocation perhaps to some of these types of investments, we are securing access at an institutional level. And I think that's my first point, Robin, would be with size comes privilege. With size comes access. And I really think that's really at the heart of your question. I mean, if you're Yale and you're managing a $30 or $40 billion endowment, you arguably have access to investments that your average typical advisory firm will not have access to. Mercer is not the typical advisory firm, not just in terms of our size, but also how we operate the organization. So naturally at $90 or billion or so in assets under management, we can actually go to the very best private equity and venture managers in the world and negotiate access to those particular opportunities. I think the second thing I would highlight, Robin, is that with all investments and with all investment philosophies, carefully managing investor expectations is critically important, right? Many investors nowadays are new to private equity. It is a very popular asset class. We're seeing the proliferation of all kinds of private equity investments and alternative investment vehicles on Wall Street. But making sure that we carefully pair the right investors with the right investments, with the right expectations is still critical.
So I also want to ask you about the secular shifts that we're seeing play out today. You're talking about AI, changing demographics, energy transitions, deglobalization. They don't have long historical data sets. So how do you incorporate new structural changes into your investment thinking when the data is incomplete?
That's a great question. And I think the first thing I would say, I'd make a couple of points on this one, Robin. The first thing I would say is that if you think about something like AI or the energy transition, while those specific developments are new, what is not new is technological innovation, right? Ever since the days ever since the creation of the wheel, right, we have had technological innovation. We've had energy transition before throughout human history. And so while certainly nowadays things arguably are different, I would argue it definitely rhymes, right? So when you think of AI, by the way, is not that new. I mean, it's actually been around for a while. Now it's ChatGPT is new and Copilot and all those other things are certainly new. But I think there has been a history of technological disruption certainly in this country for the past 200 years. And so I think you can look to the past for some examples for how perhaps to think about it. So that'd be my first point, is that I'm not convinced that technological innovation is as, quote, new as the media, the press, or some of the talking pundits would have us believe. Number two would be is if you are already building a broadly diversified market-based portfolio, the great thing is you don't have to try to predict where these trends are going to go. Right? I mean, if you look at NVIDIA, right, here's a company that's really at the forefront of the AI revolution. If you just owned a simple S&P 500 index fund today, you already have a significant allocation to one of the very biggest players in the AI revolution. And think about that for a moment. You know, Rusty, if you and I owned only an S&P 500 index fund in 1990, and if we fell asleep in 1990 and just woke up 10 minutes ago, the great thing is you and I already have exposure, I would argue a lot of exposure to AI. It's already in our portfolios. We didn't have to do anything. We didn't have to predict. So I think that'd be my second point, Robin, is that when you have an investment philosophy like ours, you don't have to try to predict the future.
All right. So my next question is perhaps just the flip side of the coin of the last question, and that is, when it comes to evidence-based investing, some would say some of it hasn't worked in recent years. So let's just pick on the value factor, for instance. You know, some would say value hasn't been working here for some time. So how do you determine when a secular shift truly changes the investing landscape versus when it's simply just another market cycle?
Yeah, I mean, I think, first off, I would echo what I said in the prior question, is that you want to be careful trying to predict these things. Right? If you and I were to rewind the tape and go back to the end of 2009, I think every strategist on Wall Street was forecasting that value was going to own the market for the next 10 years and that non-US was going to dominate, right? We forget that it was non-US equities that significantly outperformed US equities during the first decade of the 2000s. And so I would be very careful trying to predict these things. And so, Rusty, I come back to really investment philosophy, staying broadly diversified. It's one thing to have a mild value tilt in a portfolio. And look, I of all the different factors that you and I can get dorked out talking about, that's probably my favorite. It's the most intuitive. We can all, footnote Warren Buffett, and that makes us feel good and makes us feel smart. But at the end of the day, regardless of your view, whether you want a value tilt in a portfolio or a growth tilt or a momentum tilt or a tech tilt, I think it's important that we carefully meter those allocations, right? Position sizing is arguably one of the biggest mistakes that most investors fail to get right. And so even if you have a factor-based portfolio with a value tilt, I think being careful not to go all in or to over allocate to things like this is critically important. Our portfolios have a very mild factor tilt, but over the past decade plus, even though value has underperformed, we've largely delivered market-like returns to our investors just because we're so broadly diversified. And I think that's ultimately what we should be focused on doing.
Yeah, well said. So as a chief investment officer, how do you balance the data-driven discipline with the human side of investing? Again, that's client emotions, behaviors, and their expectations.
I think it's important to remember that behind all investments are investors, and they are human. Even the largest institutional investors in the world are guided by humans. And what that means is, they all have their own emotions, their own biases, their own heuristics. And as personal investors, we all have our own preferences and constraints, right? Perhaps you work for a publicly traded company and you can't invest in your employer stock for obvious reasons. I think this really comes back to incorporating a lot of the technological innovation that we've seen in the RIA technology ecosystem over the past decade, right? Think of the things that Orion and Envestnet and other platforms like AssetMark have really advanced. So being able to take a lot of that technological innovation, working with investors to personalize their portfolios, to put in place things like capital gains budgets, putting in place do not sell constraints or do not buy constraints, being able to really incorporate that technology, Rusty, to personalize the portfolio is really empowering for investors, but really also helps advisors to build portfolios that clients can hold on to through good markets and bad. And that ultimately is really going to help investors capture those market returns that they need in order to achieve their goals. So I think really incorporating that technology is critical. I think having a planning-based framework is absolutely necessary in order to help investors understand why they're invested in the portfolios that they are, and to help them understand what the impacts would be of the different decisions that they as investors have to make, right? Think of the asset allocation decision. Think of the implementation decision. Do we go active? Do we stay passive? Do we use factors? All of those decisions will have a very meaningful impact ultimately on their net returns.
This episode of Invest Well, Be Well is brought to you by Main Management LLC, a pioneer in actively managed ETFs since 2002. Main Management starts with a clear fiduciary focus, delivering the transparency and personal attention you'd expect from a boutique firm. They provide financial advisors with solutions, not products. Main also believes investors should keep more of what they earn, emphasizing net of fee after-tax performance to help clients retain more of their returns. I've known Main Management for years. I've met thousands of managers over the course of my career, and one quality I really value: they invest alongside their clients. They eat their own cooking. Over 10% of the assets they manage are their own partner assets, and more than half of the firm are partners themselves. That says a lot. To learn more about Main strategies, including buy right hedged equity, U.S. sector rotation, thematic innovation, and all asset models, please visit their website at mainmgt.com.
So along those lines, what are some of the biggest behavioral mistakes that you've seen individual investors and professional investors make, and how do you help them stay disciplined?
I mean, I'll highlight three, and I think ultimately the way that we deal with all three of these, Robin, is really the same set of tools and frameworks. The first is, especially nowadays, we see a lot of investors, at least in our judgment, erroneously mixing politics and investing. And that is very hard these days, trying to convince investors to keep the two separate. I've never seen anything good come out of a portfolio that tries to make politically based investment decisions. That'd be number one. Number two is many investors confuse the economy with markets and markets with the economy. They are not the same thing, right? They are very different, right? Markets are typically forward-looking. Economic data is almost always backward-looking. And so over the years, I've seen way too many investors confuse what's happening in the economy with what's happening in the market. I think the final error that I see quite often, I already touched on, is that many investors fail to properly position size their investments and their portfolio. And I think related to that is they fail to take a balance sheet view of their wealth. Too many investors fixate on an individual stock or a fund in a specific account without stepping back and taking a view of the broader balance sheet and really what the appropriate allocation would be to a particular company or stock or something like that. How do you manage all that? I think you manage all of that through a combination of great advisors working with clients to set appropriate context, an advisor who's not afraid to call you out as a client and challenge you when you're trying to make an over allocation, perhaps to a stock that you're really in love with, or if you're trying to make a decision based on your political beliefs. So I think having an advisor that has the courage, the integrity, and the expertise to hold us accountable as investors is critical. And then I think finally is making use of the technology that's out there, right, to help us dollar cost average into asset classes or portfolios, helping us put a capital gains budget in place. A lot of the technology that's been developed in recent years, if you really think about it, these are tools that can help us manage our behaviors and really really help keep investors in check. I tell our advisors, and I've said this to our clients, that the biggest risk in any investment portfolio isn't any of the investments, it's the investor. And so how do we appropriately manage our behaviors? And advisors and technology working together can help us do that.
Yeah. This is great so far. A lot of these questions I have personally been asked as well. And I honestly think I could hit home runs on them, but my home runs are just getting over the fence. I think you're putting them out of the ballpark so far. So you're giving me some great talking points that I could use too.
It makes me blush. Thank you.
So I have another question. I bet you get this a lot because Mercer Advisors, of course, has grown a lot through acquisitions as well. So when you acquire advisory firms that have long been independent and often view that independence as a value add for their clients, how do you strike the right balance between keeping their individuality and creating a standardized investment approach across all Mercer advisors?
It's a great question. The short answer to that one, Rusty, is very carefully. I think I would make a couple of points on this one. Number one is that we do focus on bringing on new partner firms who really do share our investment and business philosophies. And I think if you get that right and spend a lot of time making sure that we're going to get that right, making sure that it's a great fit, that ultimately the rest is just details, right? But making sure we're committed to building the best investment solutions possible for clients, making sure that we're committed to a specific operating model as an organization. As long as we get that right on the front end, I think the rest is mostly just details, important details for sure. But I think making sure it's the right fit. I mean, the best partners are those firms who are committed to helping clients and not firms that are necessarily interested in proving out a specific investment thesis in the marketplace. And one of the things I spend a lot of time with our deal team on is helping them identify what is really an asset manager that's trying to make themselves look like a wealth manager versus what is truly a wealth manager. And there are a lot of the former out there, a lot of firms that originally had their genesis, Rusty, as perhaps, a stock picking firm building portfolios of 20 stocks or 25 stocks of value stocks or dividend paying stocks. Those really aren't wealth management firms in our view, and naturally we need to move beyond trying to prove out a specific investment thesis. I think, again, appropriately marrying the technology, all of our advanced capabilities, partnering with these firms to very gently and carefully bring their clients onto our platform is naturally a must. I think the last point, Rusty, that I would make is that having deep equity ownership throughout the organization, it helps. It helps in a big way. And so when new partner firms are coming on board, they understand that they're joining something bigger than just themselves. And that's one of the great things I think that personally drives me here at Mercer is that I know that I'm part of something much bigger than just myself and that we're having a much bigger impact. So I think equitizing these folks. Our investment committee is about 65 individuals, Rusty, from across the organization. And probably half of those individuals have joined us by way of acquisition. So bringing them into the conversation, bringing them into the decision-making apparatus that governs these portfolios board and really bring us together as true partners, not just in name, but in practice.
Mm-hmm.
All right, well, we do want to switch gears now to the other theme of our show, which is stronger living. So what does a typical day or week look like for you? How do you maintain your energy with what I assume is a demanding schedule and all the travel that you do?
It's a great question. So back during COVID, when COVID first hit, my wife and I were living in suburban Philadelphia, and we prior to COVID, we had purchased a little Sears Craftsman home on the edge of Penn State University's main campus in central Pennsylvania. If you've ever been to the middle of Pennsylvania, it's very bucolic, a lot of woods and big forests and mountains and a lot of farms. And my wife grew up in this part of the state. Well, she came to me in early April of 2020 and said, I want to move. If you guys are all going to be working from home, the for sale sign is going up in the front yard, and we're going to move up to our home in State College. And so we did. So I live in a very bucolic, wonderful small college town, Penn State University. We're close to the football stadium. I love college football. So there's a Mercer tailgate up at most of the home games. And it gives me a lot of energy being in a college town. I'm an advisor to the student-run hedge fund here. It's called the Nittany Lion Fund. My neighbor is the chair of the finance department. So it's a town where there's a lot of intellectual energy, a lot of sports energy, but it's also close to nature. We do own a farm outside of town. So on the weekends, I go out there and get lots of fresh air and pretend I'm a farmer. And then my body usually reminds me that I'm not the next morning. But I think just being in a great college town really helps. Every morning I get up, 7 days a week I get up, I do about a 3 to 4 mile walk across campus. And it's a very pretty campus, and I walk across campus, I get my coffee, I listen to my podcasts, I get caught up on what's happening in the news and in the markets, and new ideas that are out there. So that really gives me a lot of energy.
It sounds like a great routine. So do you have any non-negotiables, whether that's exercise, meditation, time outdoors, maybe it's the walk every morning, or family routines that really help you stay balanced?
I think it's all of those things. My morning walks are really non-negotiables. I do those 7 days a week, even Sunday mornings. I don't care if there's 3 inches, 5 inches, 10 inches of snow on the ground, or if it's 100 degrees outside. Every morning I do my walks across campus and get my coffee. I'm a diabetic, so eating right is critically important. So making sure that I'm trying to eat, 3 balanced meals a day, and trying to be very careful. What I'm putting in my body is naturally critical. So those things tend to be non-negotiables. On the weekends, I'm a big believer in just turning off the phone and spending some time outside. And so I think we all need to just disengage for a little bit. And I think we can learn a lot from just being out in Mother Nature and breathing some fresh air and talking to the trees for a little while.
Yep.
I have 2 follow-ups to the last 2 questions. And the first one is, I used to live in a college town too, and I can speak to how awesome that is. Of course, it was Lincoln, Nebraska, at University of Nebraska, and I am a season ticket holder. Nebraska does play at Penn State, and I think actually probably a couple days after this podcast is published. So I'm afraid to put a bet on it, to tell you the truth. I mean,
Me too.
Yeah, so
It's been a tough year for us too.
all I know is that it's still, the betting site still suggests that Nebraska's coach could become the next Penn State coach. I don't think that's true. It could happen.
I know.
But I guess we'll find out soon.
He's a native son of State College, Pennsylvania. I think he grew up here. So
he said if there's only one job he would take right now, it would be the Penn State one. So there's a chance of it. So my other question is, since you brought it up, the farming. And so, many investors talk about long-term thinking, but how does your experience with farmland, how does that inform you in terms of how you think about the markets and even patience?
Wow. I think if there's one thing I've learned about Mother Nature and trying to do anything with respect to growing, whether it be fruit trees or planting a field, is that you really need to think in terms of generations, not quarters, not months, not years. That'd be the first thing, is you really do need to think really, really long term. Number 2 is that if something is a good idea, the best time to start it is right now. It's like they say, the best time to plant a tree was 20 years ago. The second best time is right now. So perhaps ironically, in some ways, you have to move quick. If you have an idea, Mother Nature is not going to wait. So you need to move quick. You need to implement those ideas now. And I think the third thing, Rusty, is really humility. Mother Nature will throw you all kinds of curveballs, most of which you probably wouldn't even expect. We had a big drought this year. Yet in the spring, we had tons and tons of rain. And so we thought it was going to be a really wet, rainy summer. Turned out to be really dry. And then by the second half of the summer, we were in the middle of a drought. So I think being prepared, that contingency planning, right? Having a plan A, but also a plan B and a plan C. I think that's a critical lesson that Mother Nature is quick to teach us.
The question I have is that you have seen much of the world. And so what does travel do for your mind and spirit? And so outside of your wonderful home, do you have a favorite place that helps you reset or find perspective?
I have many favorite places. My wife and I, we both love to travel. We've been to Europe many times. I've also done some mission work in Central America. I just love experiences that give me a different lens on the human condition, on the human experience. You see that when you travel, especially to foreign countries. So just about anywhere. In terms of my favorite places, my wife and I recently went to Italy, and that certainly gets exceptionally high marks. My family roots, my ancestry I'm of Italian descent. But Scotland really caught me by surprise. My wife and I went to Scotland some years ago, and Scotland, hands down, is probably one of the most beautiful places on the planet that we've ever been to. And there was something about Scotland where both she and I, we looked at each other. We were driving naturally on the wrong side of the road with the steering wheel that's on the other side of the car, and like we almost died a few times. But we're driving through the Scottish countryside, and we both looked at each other and said, this is the place where we both could see ourselves ultimately retiring. It was that beautiful. And we're pretty picky people, but again, Scotland, the Isle of Skye off the western coast of Scotland, there's just no words. The beauty was spectacular.
Mm-hmm. Both beautiful areas.
Yep. Totally agree with you about Scotland and Italy, two of my favorite places. Okay, one more for you. What advice would you give to other executives or investors who are trying to maintain high performance and wellness over the long run, from your perspective and your experience?
I think a couple of these may sound a little cliche, but I'll make a couple of points. Number one is, no matter how high you rise in your career, regardless of your title, regardless of where you sit in the C-suite, is always being committed to curiosity. The older I get, the more I learn, the more I realize there's a lot out there that I just don't know. And so I think being humble and always asking questions and remaining committed to ongoing learning is important. Number two is remember that it's always about people, that especially in our profession, that behind every dollar, behind every portfolio are real families that you are impacting. And I don't care if you work in financial services or if you're a healthcare executive, especially if you're a healthcare executive, perhaps, we should never forget that the decisions we make impact real families with dreams, with fears, and children and things like that. So keeping the human element centered in our focus is, I think, important. And then finally, I would say, stay focused on your family and the older I get, the more I'm trying to pay attention to my dashboard. How is my body performing, and am I eating right? Am I exercising enough, and things like that. So paying attention to our health and paying attention to our families and really maintaining that work-life balance, I think is really critical.
Good words to end on. Well, Don, thank you so much for coming on the show. Before we let you go, can you let us know where our listeners can follow your work and continue learning from you?
Oh, absolutely. Thank you, Robin. So the Mercer Advisors Market Perspectives podcast, it's a podcast that Josh Zumbrun and I put out every 2 weeks. That's certainly one place they could download that in their Apple iPhone or whatever device they're using. But also the Mercer Advisors website, we have a whole section focused on sharing knowledge. That's where we have a number of articles and what we call the weekly talking points that we put out there for investors, and whether they're clients or perhaps future clients or perhaps just casual observers who want to learn about markets or tax law changes, I would encourage folks to check out that site.
Well, Don, thank you so much. Just a couple quick comments. One, first of all, again, this is just a master class, I think, on wiser investing and stronger living. Some really strong comments. I appreciate it. And also, having grown in a farming community and having married into one, I really appreciate and agree with your kind of the common ground between farming and investing. So again, thank you for your time today. We really appreciate it.
Rusty, Robin, thank you so much. It was fun.
Good to have you. All right. Well, we will be back next week. Thanks for listening to Invest Well, Be Well. Let us know what you think. And if you like what you hear, don't forget to subscribe. This podcast is hosted by Rusty Vanneman and Robin Murray and produced by Garrett Crosby.
If you have feedback, guest suggestions, or just want to connect, please visit my website, rustysbridge.com, or email me directly at rusty@rustysbridge.com. Until next time, invest well and be well. This episode of Invest Well, Be Well is brought to you by Bonrian Capital, led by my friend and colleague of nearly 10 years, Shana Sissel. Shayna was named a top 20 wealth tech CEO in 2025, and it's no surprise. She's passionate, does the work, and knows asset managers, portfolio allocations, and alternatives like few others in the business. She's authentic, tough, and deeply cares about all her stakeholders, the kind of character you'd expect from the daughter of a police officer. If you want an investment manager who combines deep due diligence with innovative solutions and alternative investments, please check out Bonrion Capital at bonrioncapital.com.